Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitri Programmatic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer. And let me share my screen. While I'm doing that, anyone joining us for the first time today, Will and I, we do this show in the mornings to help answer any questions you may have about the Market Chameleon tools, data, analytics. If you want to come on a show and ask your question live, you're welcome to do that. We provide a link to Zoom. Click on that link, takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that. Once we let you in, you could ask your question live and direct. If you prefer to type your question, you can do that on the live chat on YouTube. Will's watching that chat. He'll read back those questions to me. And while we're waiting for more people to join us and for questions to come in, we're going to start out taking a look at the pre-market report. These are stocks trading in pre-market hours. See if we could get some insights on stocks that are moving in a pre-market hours. Okay, so I'm going to come down here, and this report, we have a list of our most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, and I see 43 stocks made our percentage gainers list, 36 on the percentage decliners list. So from this perspective, it looks like we're setting up for a bearish bias. I'm sorry, bullish bias at the open. But you could see that on this list, we do have a lot of small cap stocks. We have ETFs in there. We could have closed-end funds. We could have preferred stocks. So anything that's listed on a major U.S. exchange, if it's trading in the pre-market hours and it meets our thresholds, it can make this list. So what we want to do is narrow down this list to a smaller group of stocks. And to do that, we're going to use the filters here up top. And I'm going to use this one, an ETF. I'm going to click on that. And what this filter does is gives us a list of ETFs that we could select from. The top three, those are the broad-based ETFs. Let's pick SPY. When you select one of these ETFs, the filter below will get filtered by stocks that are holdings in that ETF. So these are the S&P 500 constituents. And here you see 5 made our percentage gainers list, none on the decliners. So from this perspective, we do look like we're set up for more bullish bias at the open. Not a huge list, but nevertheless more bullish than bearish. Let me see if we don't have questions. I'll navigate away from this page, maybe get some more insights.
Yeah, just so you know, Sarush, though he hasn't come with a question yet on Zoom, he was in. You actually did ask a question. Sorry. Good morning. Regarding my question yesterday, I always trade credit put spreads around 35 to 45 days. However, with the low volatility, most of my orders attempted to be around the same price, i.e. SPY 394s, 393s, 392s, 391s, 390s. So how do we trade in such an environment without being blown out when volatility picks up? So thanks so much.
Okay. So let me navigate to
By the way, thanks for coming back, Sarush.
Yep.
I think, Sarush, you joined us from the IBKR webinar early in the week. Were you on the IBKR webinar? Just type it into the chat. Anyways, thanks for coming in.
All right. So so I think the question is that you're following a strategy of selling a credit put spread in SPY, and you're doing it, what do you say, like 35 days out? I'm gonna set it up for everybody to see. Let's just say what is maybe like in July, something like that. And And what were the parameters?
The strikes were 394, 393, 392, 391. So between 390 and 394, those were the.
Okay,
what's
so
used.
let's just do the, just to make it easy. Why don't I'm gonna close this out. I'm gonna
Sarush, if there's
show
a particular
everybody.
put spread you want to look at, you could always type that in too.
Yeah, if he wants to look at a particular one, but over here, let's just do the 395 to make it easier, $5 one. So a credit put spread, you're selling a put and then you're buying another put with a strike below. Okay, so I'm going to do this one. Selling the 395 put 606, buying the 390 put 520. Okay, everybody see that? So I'm selling a higher strike, buying a lower strike, $5 apart. And since I'm selling one option for 606, buying another one at 520 on balance on net, I'm going to receive a credit for that. So here are the two legs. We're going to populate them here. Selling the July 21st 395 put 606, buying the 390 put 520. I'm going to hit calculate here. And this is what the payout diagram looks like. And your credit over here is 86 cents. All right. So as you can see in the payout diagram, that's the max you can make, 86 cents. And it's as long as the stock stays in this price range. Okay. In this price range right here. If the stock falls, and this is at expiration, if it drops, there's your break even around 394. It really falls and just, continues to go down, then this is a $5 put spread. So your max loss will be $414 because if you sell something 86 cents, buy it back for $5, that's a $4.14 loss, right? So that's your payout diagram. And when you're looking at it, right, at expiration, really with this put spread, what you're doing is kind of, it's mostly, if this is all you're doing, you're putting on this put spread and waiting, you're really your outlook is that it will stay above those strike prices, right? So the stock is going to stay above 395 or finish above 395 on that expiration. All right. So that's what that wager, that risk is. And you're risking $4.14 to make 86 cents. And we could go through. So that is your outlook. All right. That is your risk. And if the stock drops, this is going to be your loss. Right. If that's what your spread is, that's your loss. And the question is, what was the question?
The question was, well, he's trying to figure out a way to trade. He likes taking in a credit, but he's also worried about a vol explosion. I mean, I don't think you can sell anything and not worry about a vol increasing, because that's your risk, right? If you're going to take in a credit, that's going to be your risk, is vol exploding.
Right. So this initial, you're short a little bit of Vega, but you are selling and buying an option. So it's not really just a short Vega play, because you are buying an option, you're selling an option, and you're stopping yourself out to the downside. And even if volatility goes up, okay, it's more right now unhedged. It's more of a directional bet. Because if volatility goes up, it depends where the stock is. Because if the stock is closer to your long strike, right, well, you're going to be long Vega there, right? And if it's closer to your short strike, you're going to be short Vega. So this is more of a direction, right? So it's a directional, basically because you're not trading volatility, right? It's not like unless you're scalping your gamma, you're not trading volatility here. You got to keep that in mind. We did this on our webinar. If you're trading volatility, you're trading your gamma. If you're just putting on a position and holding it, you're not trading volatility. Trading volatility, you're trading your gamma, you're trading realized vol versus implied. So a couple of things here that you are doing is you're just sitting here. If this is all you're doing, you're sitting here and hoping that the stock will remain above this strike price, okay, at expiration. Another thing you did when you put on the trade is this a good price or not, right? Are you receiving a decent price, or is it low? And if it's low, it might be worth waiting. And we have several ways to try to price that. So we'll do that now. I'm going to go here to the distribution of returns. And this is what this is saying here. Right now, this is the price of this spread, 86 cents, 90 cents. Right. So if you're selling it, you're selling it somewhere here, either 86 cents, maybe you could get better, 88 cents. And we think, what is it worth? How much do we think it's actually worth? And looking historically, how the stock moved, right? How the stock moved in the last 4 years, given the same amount of days to expiration, whatever the days to expiration is here, I think it's over here, 48 days, given the same distance away of the stock price from the strikes, on average, in the last 4 years, it was worth, by expiration, it was worth less, it was worth more. On average, it was worth $1. All right, so if we took the average end value right now, this is below. So you have to feel more strongly about the market, staying higher here, because if we took the average end value, you're selling it below that price. Okay, that's like the long-term expected value. If we took and said, well, how often did this spread result by expiration? Were you buying it back for less than 86 cents? So if you sold it for 86 cents, what is the frequency of times that this spread historically ended lower? Well, that happened 80% of the time. So only 20% of the time historically, it was above there. But obviously, if you're worried about it, you got to take that into consideration. So that's using 4 years of data. We could change that, and let's say we only use 2 years of data, more recent data. We could reload it just to test it out. So you see, in the last 2 years, it was worth as much as, on average, $1.50. So we had more volatility lately, right? Especially, I think, in the last year, we had more volatility. So, well, no. So in the last year, that's the same. In the last 2 years, you could see here how that changes. Let's go back to 4 years. And what else we could test is, what if we used, right now we're using a data which we correlate to implied volatility similar to today. So basically, we're looking at implied volatilities in the low range because that's where we are now. What if we used no matter where the implied vols were, we used all the data, we reran it. So basically same thing. So using all the data. Yep, let me see. It was the same thing, basically. Let me see. Let's see if we use just the high, if implied volatility really went up. Let me see that. So even when implied vols were up, we didn't have any else rated. Okay. So basically that's where between $1 and $1.50, right? What if we looked at it from a different perspective and said, well, that would be based on how the stock price moved. But we're also buying one option and selling on one option on different strikes. And when we do that, we could see that the implied volatility is different on different strikes. And since we're buying one and selling one, you're trading skew, right? Because that's what skew is. Different implied volatilities on different strikes. And then the question is, well, how does this skew today? How does these two options relate to each other based on history? Is this a good skew or a bad skew? Because, if the skew on this is underpriced and this is overpriced, then you're really not getting a great deal, right? And you might want to wait for that skew to come back into line. So how do we measure that? So I'm going to go here to the IBKR, and this is also going back 4 years, and it's ignoring what the stock price actually did. What this is looking at is, given, that we have 48 trading days left for each option, and these options are this far apart, what is the relationship usually between these two options, right? That's what it's going. It's going back and looking at our historical database and looking at that relationship and then calculating today's Theo. So you could see on average, you get 86 cents. So that's really kind of in line with the historical average. Let me see if we change those all results. So that's when implied volatilities are low. If we just took all the results we had, doesn't matter if vols were high or low, then on average, you would begin a $1.02 credit versus 86 today. And you could see the range as low as 54 cents, as high as $1.99. So that's the range, but you are selling, below this if we used all the results. Let's go back to the
Dave?
Yep.
Sarush is asking, on MarketChameleon, the theoretical value calculated using the historical price distribution, is it possible to add a stop loss, i.e. closing position when the spread has reached he's saying reached 2.8 times the initial premium received when sold? And I know there's no such thing.
Well, the historical return distribution is just looking at data. I'm not sure what you mean. The spread itself is like a stop loss, right? Because you have defined risk. You already have defined risk when you put on the trade. So over here you don't have unlimited risk. This is your defined risk. So the reason you're even doing a spread, which is I think smart, is that you're defining your risk ahead of time. This is what I'm willing to lose, right?
Yeah, no, because he says there were some comments before. He says, I always close my trades very near 50% or at 50% profit. I never wait till expiration because of the tail risk. And because it's a spread, I'm not sure there is the tail risk, right? I guess there's pin risk, right? If it moves to your short strike, if you could get
you might have pin rate, yeah.
But you can take that, you can take off one side of it, but so as long as the spread's trading, you always are protected to the tail.
Yeah, like even if it goes down 20%, you see it's still 400.
So you're worried about pin risk. You'd want to close the
trade, yeah, so you don't get
or at least the short side, right? Yeah.
Yeah, because because what will happen is if the stock is in between your strikes at expiration, well, then what happens is that one of the options is worthless, it goes away, but the other option is in the money. So you end up holding, it's going to get assigned or exercised. And then what happens is that you come in, either long or short of stock after expiration. So that you have to, you might want to close out, because if it's in between the strikes, right, and its expiration, the options go away. So it's either going to be worthless or get converted to stock. So that's basically you got to watch your risks. But how you trade and manage your risk is different than trying to evaluate the options themselves. So once you have a portfolio of risk, and that's what trading is, you're holding inventory of risk, and how you're managing it has so many factors in there that there's no way to give an answer what's the best way to manage something ahead of time, because it all depends on your inventory. So many different factors that go into managing risk, which is, as a trader, that's your job. You have to know how to manage it, identify your risk, know your risk, value your risk, explain your risk. That's really important. But while I'm doing this really quickly, I did want to show you, why are we going over these prices? Like, why do we even do these theoretical values, IBKRs, and I wanted to show you guys something, because we do emphasize this a lot. Like, you want to build models out there to give you benchmarks and understanding of that. It's one way to identify and price risk. And it's usually your starting point is, can I price it? Can I explain it? Can I hedge it? Can I manage it? Like, all these are questions. And here's a nice article here. So this article is on Bloomberg, right? And the Bloomberg article, I think you could go read it today, was talking about, I'm going to go here, Ken Griffin's handpicked math prodigy. And Ken Griffin, obviously, that's heads Citadel Securities. He's worth whatever, 50.
Started in his dorm room at Harvard trading treasury bills.
Yeah, exactly. And this is one of the biggest success stories on Wall Street, right? He's a market maker, started as a market making firm. I mean, we used to trade on the floor of the exchange, next to Citadel traders ourselves. And this is one of the top tier trading firms out there, consistently making billions of dollars per year, probably you would say one of the top tier. And it goes through an interesting article, but this is what I wanted to jump to, because you get insights from, what what they're focusing. So you could read the whole thing and you could see here. So what is the trick, which he honed while working in his doctorate near Napa Valley, is to take something that seems subjective or chaotic and break it into pieces that can be mapped and understood. This is right. I always repeat this. And he sees this markets the same way. At Citadel, he said, building new business lines starts with figuring out, look at this, figuring out how to instantly find the correct price of an asset. See this? And this is the cornerstone. This is always your starting point. Because if all you're doing is looking at prices moving around, you're really not doing much, right? You're more in that bucket of gamblers. So very important to understand. This is why we focus on trying to find the correct price of an asset, which doesn't mean that when we talk about that, also it's important to understand that, yeah.
I'm getting requests for the link to the article.
So this is
can you put it in the Zoom chat, and I'll copy it and put it in the.
How do I do that? Well,
go up to the URL up top where it says Bloomberg. Just grab that, and then go to chat down below and just pop it into the chat.
Okay, hold on. Wait, it doesn't let me. It doesn't.
You can't copy and paste it.
No, I think you're the only one.
All right, I will search for that article and try to get it. It's Ken Griffin's handpicked map. All right.
Yeah. So I think that the major point that we want to make, and we kind of keep coming back. Why do I bring these up? Why do I bring these? Why do we bring these up here? Why do we try to price a stock, with our valuations? this is always going to be your starting point. You know, it's not the end point. This is your start. This is like where you should already have it prepared prior, you know, to start making decisions, trading decisions, and these are your benchmarks. And when we talk about the correct price, right, it's important to understand that there's no mathematical formula that could price a stock with exact precision, that to the penny, that this is what it has to be worth. Okay, it's not always like that, because you're still dealing with uncertainties unless you could figure out a way to hedge off all your risk, but you're going to be carrying risk. The idea is that your benchmarks, your prices are good guidance, you know, for what you're doing. And it explains the market as well, because if the market is disagreeing with your prices, if it's way off, then you have to look what is causing that, why. You know, there could be an explanation, because the math, the modeling, even the machine learning, you know, it only knows and deals with the inputs that you put in there, right? So it can't go out there and explain things that are not that are just not available to them, or what else is going on. So if there's missing information, or there's something going on that the markets do deserve to diverge from their regular, you know, benchmark or pricing, then you have to take that into account. And when we talk about, you know, mapping, you know, we talk about positioning. That's what we do. Like, we try to explain the order flow and options and so forth, because you're taking data, and data is dispersed all over the place, right? So the data is very dispersed, and the data seems chaotic itself, because these are raw data points. You know, like take data from the exchanges, and they're gonna you know, shove 1 million data points down your throat in every second. So, you know, you have to take that, right? You have to take that and put those pieces together to build you, so you have a much clearer picture of what's going on. You know, we kind of started showing that, like with VWAP tables and so forth. But this, you could read this article, and a lot of this article doesn't deal with it. A lot of this article just talks about their background and so forth. I just wanted to point out, because this was the key takeaway here, right? I think that this was the key takeaway, because those are in line with our experience, people in Wall Street. You know, what do they focus on? What are the major things you focus on, and what do you want to do first?
That was an awesome Friday webinar, D.
Right. All right, everyone.
Actually, we have one more. Look at Saru. She stepped up and gave us the article in the chat too.
Oh, nice. Thank you.
And thanks for joining us from the IBKR webinar, Sarush, and bringing the questions. It's been a great couple of days. I was able to get the webinar or the article real quick, and they're all thankful that you presented it, D, and the information around it. Thank you so much.
All right, everyone, stay safe out there. Have a great trading day. Have a great weekend, and hope to see you guys on Monday.
All right. Have a great day, everyone. We'll see you on